prepare for next year, let's go straight to the traders. We have John Gagliardi and Larry Shover joining us now. John, Larry, thanks for joining us. Let's do the floor show. What's the catalyst, Larry, for 2022?
Well, the catalyst is we're in a much stronger place than we were a year ago. The consumer's in much better footing. I mean, we've added 6 million jobs to the economy. I know there's still problems with that, with the participation rate, and also we've gotten the news that the Fed's going to taper and eventually raise rates, and the stock market doesn't seem to be flinched by all that. So are we going to see 4 years of double-digit growth? I'm not so sure. In fact, I think not. But we did see 3 in a row of almost 23% on average.
Yeah, so it's interesting that the biggest risk, I think you would agree, it would be the Fed and rising interest rates, but you're not saying that's really a risk. So, John, what do you think the biggest catalyst and risks are?
Well, the biggest catalyst have always been, I've been saying it for years now, demographics. It's the millennials. That's the largest upside potential, and they're just going to keep growing. By 2026, they will represent 75% of the workforce. And as they're going into family formation, they're buying houses, they're buying stuff, they're buying cars, and all of those things are rallying. If you look at home builders, REITs, financials, they've been in rally mode. They've broken out to their all-time highs that they haven't seen since 2007. So they're all happening.
Larry, are you predicting a baby boom then in 2022? As millennials move out of the cities to the suburbs? They look at all that space and they say, well, we might as well have kids.
Yeah, at some point, Larry, that will happen. It's at some point. But things are moving quickly, and we're seeing so many shifts, like in real estate and stocks, and like cyclicals drove the rally this past year. And with all the fracturing and underemployment in mind and inflation, I just don't see double-digit growth again. And so with that in mind, I'm getting a little bit more defensive in my portfolio, given the changes that we've been seeing.
Yeah, before we go back to John, Larry, just go through your portfolio a little bit, because you've definitely taken a defensive tone. I know you like United Health when it comes to healthcare. What are some of the other names that you like?
Yeah, I like United Health. I like Procter & Gamble, and actually a defensive tech, which would be like Hewlett-Packard. I mean, good grief. I know it's up 33% on the year, but a price-to-earnings ratio of 6 and a yielding like 3%. So I'm a little bit concerned that people think that growth is going to continue double digits, and I don't think it will. And I'd rather be in stocks that at least are paying dividends. The return on equity is really high, and they can withstand perhaps some interest rate pressure if we should see that in sometime during next year.
But the midterms, John, that could change anything, and it could certainly change the Fed and how they look at interest rates and the end to quantitative easing. Your thoughts on the potential of the midterm elections to muck things up in the new year? Oh, that's how he feels about it, Larry. I'll give you that question.
Yeah, midterms, historically, they haven't been terrible for at least our assets, the U.S. dollar, et cetera, although there's always a first time. But what it does often begets gridlock. And gridlock, a lot of the market is counting on this Build Back Better bill getting passed or some iteration thereof, and a lot of growth factors. And so this is the first year, and I think 2 or 3, that we're starting the year without any artificial stimulus. And so with the elections coming up, midterms, that spells gridlock, and perhaps people get a little bit nervous about that.
Yeah. And that's an excellent point. The market has been lifted the past 2 years by every form of stimulus that you can imagine, which has created, in part, the inflationary environment that we're in. And now we don't have that, as far as we know. We might get some new catalysts like Build Back Better in the new year, but right now we don't have that, and that does change the narrative. You might also see, Larry, this new generation of investors, typically younger, but people who are investing in cryptos and the meme stocks, and they're doing the casino-like gambling on apps like Robinhood, they haven't experienced big losses. And you said it before. We had 3 straight years of double-digit gains for the S&P 500. I mean, what if we don't get that in 2022? I wonder how the retail traders, the inexperienced traders, react to that.
Yeah, I mean, we're 3 years in a row, not quite as good as the mid to end 90s, which we had 26% yearly average. But yeah, a lot of people, a lot of these newer investors have not seen a flat market, let alone a market that really trends downward. And so we've all seen nothing but go up by anything rally. And, that could change. It could change in a heartbeat without warning. It could also change for any reason or no reason at all. But at this point, it's more about the fear of missing out and seeing the stocks continue to go up. So I better get in without any kind of game plan with regards to that whole thing reverses. And, I started trading in 1985. And so history be a guide. We're always going to have a period where things backpedal and regress, and it's going to be interesting to see how these new traders figure that out.
You said fear of missing out. I thought FOMO, and I'm trying to think of a new acronym for 2022. Are you working any out in your head? Do you have any new ones?
I'm working on some type of acronym.
Keep us posted.
But yeah, it's more about just
Larry,
keep in mind. Yeah.
Thank you very much, Larry. I do appreciate it. Happy New Year to you and your family.